You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thank you so much for tuning in today. On today's show, we are going to be talking about the rationale behind entering new trades and specifically trying to answer these questions that I typically get from pro and elite members around this idea of how we pick trades, how we go over and choose different ticker symbols. And so I wanted to spend today's show kind of walking through this process with a lot of you guys right now on the podcast to help you out. So again, the purpose of this is really, or the driver of this podcast has been questions that I get, which are along the lines of, it seems that you covered new tickers, but you don't say why you choose them, or it seems that you are trading this ticker, but you don't say why you're trading that ticker and why not this other ticker. And so it seems like there's a lot of things that I'm leaving behind the scenes when I'm actually not. And so I want to try to open up the gates here and kind of show you guys my thought process for new trades and how I choose positions, strategies, etc. So there's a lot that might go into this, but it's honestly not that complicated. When you get down to the brass tacks, it's probably a lot of big rocks, as I call them, like the really important nuggets that you have to get. You master those and you take care of 90% of the problems that you might be facing right now when it comes to entering or picking new trades. The little intricacies will come over time as you get more familiar with different tickers and different securities, different strategies, different implied volatility in markets as well. That will kind of fill in the gaps. But as long as you get these main components that we're going to be talking about, which I think there's really kind of four main components, then you should be capturing, like I said, 90% of the potential problem and helping to solve it. So what I want to do today is kind of go through my four things that I generally think about when entering new trades. Now, this to me is not something that I review every time that I make a trade, but this is the hierarchy, I guess, of how I think about and start to plan my portfolio for any given expiration period. And these are what I consider to be the most important elements of what you should be trying to do. Now, in our case, the first thing that I have to tell you, and a really important note as we go through these four things, is that you can trade whatever you want to trade. And I truly say that because it ultimately doesn't matter in the really long term what ticker symbols you ultimately decide to trade. And the reason I know this is because there's been a lot of research in this field of diversification, not only relating to single index diversification, but also to sector and industry diversification. And what they found in multiple different places, there's a bunch of research out there. You can just search online and find, diversification portfolios and index versus balanced, etc. But what they generally find is that no matter what diversification split you have, they all seem to converge around the same area over time. So if you are, just to use an extreme example, if you're 50% stocks and 50% bonds, and somebody else is 80% stocks and 20% bonds, you might end up around the same area, or you likely are going to end up around the same area over time. Now, of course, there's going to be differences in one year versus another year. You're going to have different levels of volatility in your portfolio, right? A stock portfolio might be more volatile than a half stock, half bond portfolio, but the diversity mix doesn't matter too much. And the industry or sector mix doesn't matter too much on the long, grand scheme of things. So when I say you trade whatever you want, I truly mean that. I mean, there's no right or wrong answer to what you trade. I'll go through kind of how I think about setting up my portfolio and how I think about trading and the reasons why I set up this way. But if you just wanted to trade SPY or SPX, knock your socks off. If you just want to trade OIH or you just want to trade GLD, I mean, again, knock your socks off. Your performance over the long run should not be dramatically different. So you're going to have probably differences in volatility and how you get there, but it shouldn't be dramatically different if you're using a very similar option strategy to get there. All right, so if that makes sense now, then the next portion of it is that you have to understand, or the next important note, is that diversification of any kind helps to smooth and reduce volatility. Now, to me, this is the most critical aspect. So if you said, most people say to me now, well, Kirk, if we can trade anything we want, why don't we just trade one ticker symbol? Why don't we just trade SPX? Why don't we just trade Tesla or Facebook? And the reason we don't do that is because there's way too much systematic or asystematic risk, however you look at it, in doing just one single ticker symbol or one single industry or sector. So for me, I would much rather have smoother, more stable, less volatile growth in my portfolio than I would rather have all my focus on one ticker symbol and huge ups and downs, which means that I could have a 35% gain one year, but I could have a 50% drawdown the next. And I'm not willing to do that. I don't think many people rationally would do that if you actually started trading, right? People would say that they might do that, but then you actually get them in front of a trading screen or you get them in front of a portfolio that's going through a 50% drawdown, their mind changes pretty quick, right? So for me, diversification helps smooth and reduce our volatility long term. And so part of that diversification means that on the furthest end of the extreme, there is a thing in options trading as being overly diversified. And what I mean by that is that you get people who start trading in options and they understand the concept of diversification, but they take it to an extreme where they get no marginal benefit from doing it. So if we use this kind of thought process of thinking that, okay, if we're going to trade one ticker symbol and we want to diversify, well, we get a huge benefit by now trading two ticker symbols, right? So the benefit in diversification or the added value of diversification is potentially greatest when you add the second ticker symbol, when you go from one symbol to two. Now add a third symbol, you probably have a huge benefit to diversification, but the benefit is maybe less overall than going from one to two. So now as we add ticker symbols to our portfolio, you can see that there's a reduction in marginal benefit by adding each additional symbol. And so what this ends up being is that if we were trading, let's say 500 ticker symbols, if we added 501 ticker symbols to our portfolio, we would get almost no benefit of diversification, probably zero benefit of diversification, or it'd be so small that we couldn't even recognize it or calculate it because we've already got 500 different tickers. And so what people do is they overload this to the extreme. In my opinion, I think you could probably have somewhere in the neighborhood of 15 to 20 positions on the high end, 10 to 15 positions on the, kind of middle of the range or low end. If you're somewhere around there and you have a good split in ticker symbols, and we'll talk about that here in step number 4, then what happens is you probably get about as much diversification benefit as you could possibly want. So anything really over that, and it's got to be an opportunistic environment. It's got to be a really great trade that fits in the portfolio, but you get no real diversification benefit by going beyond that. So if that helps narrow the focus now, that could help you in just trying to find trades. If you realize you don't really have to go out and kill yourself to go find all these different trades every single month. You kind of stick to these core groupings or sectors or industries. You end up getting the vast majority of benefit of diversification. All right, so let's go through the 4 things here because I think this is really important to kind of, go through my, again, hierarchy of how I think about, building portfolios, entering new positions, how they fit in. I think this will help out. And again, as always, if you guys have questions, let me know in the show notes, optionalpha.com/show143. So the first thing I look at is high IV. And I look at high IV first because it's the easiest, most simplistic, and the best edge that we potentially have in trading. So when I go to look for trades, and right now we're using just our simple watch list tool that we have on Option Alpha, which everybody can get access to if you want to. When I go to look for trades, all I'm looking for first and foremost are those positions that have high IV first. It's kind of like my first level of screening or filtering for positions. And the reason I do that is, like I said, because we know from our research and our back testing that when you have high implied volatility setups, you generally make more money, you have shorter durations, lower drawdowns, all the good things that come with trading high implied volatility. So what I try to do is I try to filter for, say, ETFs first, and then I filter for high implied volatility to lowest implied volatility. Very easy way that we can just filter. And right now in our charts at the time that we're doing this podcast, USO, EWZ, and GDX all show up in the top. So they have the highest implied volatility right now. based on all the different ticker symbols that we track. So this is good. This tells me, okay, these are potential candidates for me to make a trade. Now, I don't end it there and I don't just trade only the highest implied volatility stuff. Now, this is where I think is a little bit different, and maybe people start to disconnect what I actually do with what they think they should be doing. Many people would think, or I've seen people email me and say, well, I just trade the top 10 ETFs that have the highest implied volatility, or the top 10 stocks that have the highest implied volatility. And conceptually, I understand why they're doing that, but they're missing a really important component. And that component is, well, what if those top 10 ETFs that have high implied volatility are all in the same industry? What if all of the things that have high implied volatility right now are in the oil industry or the energy or emerging markets? Now what you've done, even though you have 10 different ticker symbols in your portfolio, you've consolidated basically that portfolio into one sector, one industry. And so, yes, you're trading the highest implied volatility stuff, but you have no benefit of diversification. You're trading basically all the same cousins and brothers in the same industry and sector. And so that may or may not end up working out pretty well. So when I say that I sort first by high implied volatility, that's truly what I mean. That's my first level of sorting. And then from there, what I start doing is I start trying to find different tickers. So the easiest way to look at this is I'm just trying to look for different tickers in potentially different industries. So in the case of the top 3 right now, using our watch list and toolbox software, right now we have USO, which is oil. We have EWZ, which is a Brazil, so emerging market. And then we have gold, GDX, which is a commodity or another like precious metal. You could put it in that category too. So these ones have 3 different tickers in 3 separate industries, categories, however you want to think about them. So for me, this works out pretty well. I generally would want to trade high implied volatility. The top 3 here we want to trade because they're all high implied volatility. Plus we have the added benefit that they're across different industries and sectors. Now, if, for example, my top 3 looked like this, maybe I would change my mind. So let's say my top 3 tickers were, and they're not right now, but just for the sake of argument, USO, OIH, and XOP. Now, all 3 of those tickers are in the oil and energy and gas related industry. And so although they might all have high implied volatility right now, maybe I only want to choose 1 or 2 at the most of those, but I definitely don't need to trade all 3 of them. And this means, yes, I will skip over some of the tickers that have the highest implied volatility because I don't need to pigeonhole myself in that industry or that sector. So hopefully that concept makes sense because I see a lot of people, again, doing that. They just trade the highest implied volatility tickers, understanding that they're now pigeonholing themselves into that area or that sector. So again, number 2 is I try to look for different tickers in different sectors. Then number 3 is I try to balance my portfolio directionally. Now this is where once we have made this list of tickers that we potentially want to trade that have high implied volatility and we work kind of backwards on the list, now I start looking at, okay, if I'm going to trade GDX and I'm going to trade USO or EWZ, what does my portfolio need? Now in this case, this is how we start transitioning to a strategy type development or question. So we've chosen the ticker. Now we need to choose the strategy. Well, part of choosing the strategy might be, what does my portfolio need? Am I currently too bearish in my portfolio? So is my beta weighted portfolio too bearish? In which case I might need a bullish position or a position that adds positive deltas and positive betas to my portfolio. That may change the nature of the type of trade that I actually execute in GDX or EWZ or USO. And so for this, we'll just use the backtester and trade optimizer to basically say, look, we need bearish positions. So if I'm going to be bearish in GDX or if I'm going to be bearish in EWZ, what's the best possible trade that I can make right now? And that's why we built these tools to kind of complement one another. The toolbox software and the watch list gives you the ability to scan for the right tickers. Now you start transitioning that over to the backtester and to the trade optimizer, and that tells you exactly what strategies to use based on what your portfolio needs or what your directional assumption is. So the key here is not only just choosing the right mix of tickers, I think, to get a little bit of diversity in your portfolio, but also to choose the right strategies so that you're overall neutral, so that you don't have too much one directional or a directional risk in your portfolio. So that's number 3 for me, is when I'm choosing trades and choosing strategies, that's the most paramount things that I try to do is choose the right tickers, high IV, and directionally balanced portfolio. Number 4 then is just for me called filling the gaps. And so what I try to do with my portfolio is I try to build, let's say, this core grouping of different industries or sectors. And I'll go through those here in a second. Once I do that, once I have most of those in place, not that I have to always have the same ones in place, so please don't misunderstand. I don't always have to be trading the same, 5 or 10 different core positions. I generally like to rotate these based on high implied volatility, but if I can get into most of these, I try to. But once I have those in place, I try to fill in the gaps with other trades that are one-off opportunistic type environments. So for example, 2 recent one-off trades would be things like VXX and Tesla. We recently traded VXX and Tesla, both profitable trades. Those to me are not core positions necessarily. I'm not going to always be trading Tesla, but we saw an opportunity to trade Tesla. That to me fills a small gap. It gives us a little bit more diversification for that moment in time. It gives us a better trading opportunity that kind of comes across our plate or our desk. And so we made that trade. Same thing with VXX. Good trading opportunity at the time. Doesn't mean it will always be there. It could be another 4 months before we have another opportunity in VXX. But when they come across, we're going to use those to fill the gaps. So when I talk about core positions, what I'm talking about is potentially having trades in these following sectors or industries. Now, again, just to reiterate, we don't always have to have them, but if I can get a good mix of these on an ongoing basis, I should give myself as much diversification as humanly possible, or as much as I need in my portfolio to get the most benefit of diversification possible. So we try to usually have positions in at least one US index. So it could be the Qs, DIA, SPY, IWM, etc. Some sort of emerging market exposure. This is EEM, EWW, EWZ. We try to have some sort of exposure to commodities. This could be things like gold. It could be silver. It could be just a commodity basket in general. We try to have exposure to energy. So again, this could be oil. This could be things like XLE, which is an energy ETF. So automatically you're starting to see kind of the thought process and why we choose different tickers, right? Because we're starting to try to check some of these boxes every time that we're building a portfolio. We would also like to have exposure to bonds on an ongoing basis. That's a great addition to our portfolio. In fact, just to pause for 1 minute and talk about bonds, we have traded TLT for the last 2 years, even though pretty much every month we traded TLT, even though it's got super low implied volatility right now. And in many cases, the IV rank in bonds and TLT is, 5 or 10, insanely low, would never come up to the top of a list on a screener for our watch list. But the reason that we consistently trade it is because it adds diversification to our portfolio. And so even though implied volatility is low, we get a huge benefit in our portfolio by trading something like bonds, which has low implied volatility but adds a lot of diversification. Ironically enough, last year, TLT was one of our highest performing tickers. So again, it shows you that just because implied volatility is low doesn't mean that you can't generate a lot of money trading these positions. TLT was a great performer for us last year, has already been an amazing performer for us this year, and we will continue to trade it because of the diversification benefit that it adds to the portfolio. So again, we have US indexes, emerging markets, commodities, energy, bonds. We try to also have a currency in there as well. So if we can get something like FXE, FXY, etc., we try to get some sort of currency exposure. You may even also throw gold into that mix as related currency exposure to the dollar. So there's a lot of different things that you can try to do. But, for me, we try to hit on those core ones. Every month, we try to get most of those core positions filled in our portfolio. So if I look on my watch list now, and again, I'm just going back to the watch list on the website. If we look at just top down, I'm going to read off these tickers and tell you whether I would add them or not, or potentially add them. These are truly the top tickers right now at the time we're doing this. So we have USO, EWZ, and GDX. We could potentially have trades in all 3 of those. High implied volatility, they are all in different industries. Now, number 4 on the list is SLV. Well, I probably will skip over SLV if I have a position in GDX already, right? There's no point in doing SLV necessarily because I already have exposure to precious metals. The next one down is EEM, which is emerging markets. Okay, a more broad emerging market category. We already might have a position in EWZ, which is an emerging market. So maybe we want more broad exposure, or do we want just exposure to Brazil in this case? So you could add both, or you could just add one. RSX is another one. Again, another emerging market. So you don't need to have all of these now. You can choose between these. FXI, another emerging market, is the next one down. So now we've seen in basically the top 7, we've seen 4 emerging market ETFs. Now I would say that you would want to pick maybe 2 of those to trade. Maybe you trade EEM and EWZ because they have the highest IV. Maybe you trade FXI and EEM. It doesn't matter what you choose, but don't do all 4 of those. You don't need to make a trade in all of those because you're basically just wasting this diversification potential on trades that are in the same industry and sector. Now, the next one down on the list is FXE. Now, this is interesting because FXE has fairly decent implied volatility and gives us now exposure to euro and currency. So we would potentially trade FXE. The next one down is EWW, another emerging market. So you might skip that one. EWJ, another emerging market. So you might skip that one. And now we get into a couple different ones, which are really interesting to me. Now, this is much further down on the list of high implied volatility, but again, we're trying to work backwards from implied volatility and fill these gaps of different commodity or sector or industry buckets. So the next ones down are SMH, which is semiconductors, QQQ, which is the Q, the NASDAQ, and IYR and XRT. So IYR is a real estate ETF and XRT is a retail ETF. Now, in my case, I might try to trade most of these because even though they're further down on the implied volatility list, each one of these gives me a little bit different diversification into dramatically different sectors and helps fill the gaps of maybe some of the core positions that I had up top. So I might trade SMH, I might trade the Qs and IYR for real estate and XRT for retail. And I'm really adding a lot of diversification benefit to my portfolio by doing this. And again, they're not necessarily the core positions that I always want to have, but they may be better positions right now to fill these gaps than something else. And so what you'll see is that you'll see oftentimes that these positions that fill these, gaps in our portfolio or kind of, fill out the portfolio change and rotate based on implied volatility. So currently it could be retail and tech. In 2 months, it could be utilities and healthcare that end up having the highest implied volatility. And so as long as we try to maybe fill these gaps with some of these, not all of them, maybe not even half of them, but try to just, kind of plug some holes maybe in risk, I think that adds to a much higher level of portfolio stability and less volatility going forward. So when I think about filling gaps, I think about the following industries, which is something you might want to write down or help out with. But I think about retail, I think about tech, utilities, healthcare, real estate, industrials, financials, etc. That's what I kind of think about when I choose to fill gaps. I try to look to kind of plug these holes with these other major industries and sectors within the portfolio. All right, so we've gone on for a little while now talking about this. Hopefully all this stuff has helped. Just as a recap of what we're trying to do when we're looking for or going through the rationale behind entering new trades, the gist of it is trying to build a portfolio that has as much diversification and is as neutral as possible every month moving forward. And so part of that process means always using high IV first. But the next filter beyond high IV is trying to choose different tickers in different sectors and industries. Once you have a short list of those, then you want to put them together in a way that adds to your portfolio balance. Try to build a portfolio that is balanced and neutral. That means that you can go directional on something, just go the other direction on something else. If you're bullish on energy, be bearish on currency, right? Do something that adds a lot of neutrality to your portfolio. And then finally, fill the gaps with these core industries and sectors and sub-tertiary industries and sectors when they have high implied volatility. So again, you don't have to do all of them, but this gives you a good basis for trying to choose a good mix of these on an ongoing basis. Many times my core positions and industries that I choose and trade evolve and change. Last couple of months, it's been gold and GLD has been a big portion of our portfolio because it just has high implied volatility right now. Same thing with EWZ in Brazil. That was not the case 6 months ago. Those were not on our list. We weren't trading those as much 6 or 7 months ago. But now they've kind of come into favor as far as higher implied volatility, a lot better option pricing. So now we're going to trade them as part of our mix. So again, it doesn't mean that you have to have all of these. You don't have to check every box. Please don't over-analyze and analysis paralysis this. It's just a means of looking at a framework or a strategy or system to build a portfolio by just trying to cover these big rocks or big components. So again, hopefully this helps out. All of this will be on the show notes page at optionalpha.com/show 143. So if you want to go over there and check that out or download that, you can do it again at optionalpha.com/show 143.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi Kirk, my name is Emmanuel. I am from Athens, Greece. First, thanks for the webinar. It was very useful. I am an absolute beginner. My question is, how long do you believe, with your experience, will I need to make profitable trades? Can I trade with $1,000 account? Thanks.
All right, Emmanuel from Greece, thank you so much for submitting your question. And so again, the question is really, how long does it take to see profits, especially if you're trading, let's say, $1,000 account? Now, look, I can tell you, if you're trading $1,000 account, I would say your best bet is probably actually to save a little bit more money and try to get that up to around $3,000 to $5,000. You're not going to get too far. You're not going to pedal the bike too far with just $1,000 because you just can't enter a lot of trades. So even with, let's say, $1,000 to $5,000, you're going to be at a slow pace of growth because your trades are going to be very, very small. On its smallest denominational scale, you'll probably do a $1 wide credit spread, which is taking in a $30 premium for $70 of risk. It's going to take a long time for that to really start to accumulate, but you've got to keep the end in mind. You can't assume that you're going to take a $3,000 account and double it to $6,000 and you're going to do that overnight. It's going to take some time to build up the account and to start to see things take off. Now, again, what we've talked about before is that as far as profits coming in and win rates, etc., that could be dramatically different depending on the trade cycle and the sequence of returns that you get. So I would encourage you to review show number 139, which talks about sequencing risk and why it's so important that we keep the end in mind and keep high frequency, low risk trades in place at all times, because we don't know what the sequence of returns are going to be. We don't know if we're going to have a string of winners or a string of losers, and that can have a dramatic impact on a small account. So as always, if you guys want to get your questions answered like Emmanuel submitted to us, please head on over to optionalpha.com/ask and click the big red button in the middle of the screen and leave me a private voicemail. Again, there's no software to download or install. You can do it in literally 30 seconds, a minute. Just leave me a voicemail. It goes right to me, and then we'll use it for our next Trader Q&A segment. So let's get into the closing bell segment and talk about a new trade that we got into in TLT.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so today I want to talk about a new trade that we got into in TLT, which is a bond ETF, a very popular one for us to trade, very popular, highly liquid ETF to trade options on. Now, in all honesty, this is our third position in TLT. We've gotten into two other positions for October expiration. This is our third position in TLT. We are using the same technique that we talk about, which is laddering into new trading opportunities in TLT. We've entered into sets of 3 in TLT over the last, say, 2.5 weeks. So the first set of contracts that we entered into was at 121 as far as the centered short strike for our iron butterflies. We entered into 3 of those. Then when TLT moved down, we entered into another set of laddered entries at 119. And now we're entering into our third set at 117. So as TLT has moved down, we've shifted and adjusted our strategy down with the market. So as TLT has moved, we're shifting and we're averaging down so that we spread our trade entry out, not only over time, but also over different strike prices. Now, in the case of TLT, we're selling the 117 calls and the 117 puts. That's the core or foundation of our iron butterfly strategy. It's that straddle at 117. And then we're going out on either end and buying options at 124 on the call side. and 110 on the put side. Now, both of these call and put options on the further wings are very cheap. In total, they're about $11 for each set of them. So it's really cheap protection, still allows us to take in a net credit after buying those of $229 per Iron Butterfly. So we're taking in a really good premium here, hoping that TLT stabilizes or returns a little bit higher, bounces back a little bit higher from the huge sell-off that's had. If it does, that'll give us an opportunity to take these things off well before expiration. So as always, hopefully these help out, and let me know if you guys have any questions at all on our trading alerts that we send out.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so again, I truly hope you guys enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show 143. Again, that's just the number 143, optionalpha.com/show 143. And until next time, happy trading.